That actually segues pretty nicely into the next thing I wanted to talk to you about, which is this really heavy correlation we've seen with Bitcoin and just, traditional risk on assets, especially just tech stocks. And I mean, when you just look at something like a correlation coefficient between BTC and the NASDAQ, we reached like an all-time high correlation. I think it was 2 or 3 weeks ago. It's sustained at really high levels. So like, do you think as Bitcoin, as you just mentioned, becomes more correlated with broader macro as it gets larger, do you think it just trades more in tune with what's going on in macro, and that correlation with traditional just increases? Or do you think there is a case for potentially decorrelating from traditional assets over time?
So years ago, when Bitcoin was a smaller market, the group of people that traded Bitcoin and the group of people that traded every other asset was like two very different groups with minimal overlap. And so over time, as Bitcoin reached greater levels of adoption, both retail investors and institutional investors, that Venn diagram is kind of moving closer together, where the same people own both types of assets. Um, and so naturally, I think correlation increases in that regard, right? And generally, when Bitcoin is a liquidity play and a macro play, it's going to follow that kind of risk on, risk off things. And so with the stock market during rising PMI environments, you generally see the riskier stocks do pretty well. And during the declining PMI environment, that's when things like defensive stocks or gold or bonds generally outperform some of the riskier stocks. Now, you always have exceptions, right? So in this declining PMI environment, instead of bonds doing well, bonds sold off because this was the first stagflationary declining PMI environment in a while. So there's always going to be curveballs. And so, a big question I had was how would Bitcoin hold up this time in a stagflationary environment? Because if you're going to have a decoupling, you would think that a stagflationary environment would be a decent time for it. So, you know, if you start to see margin pressure on companies and you see the Fed forced to come back and provide liquidity, I think that could be an environment where Bitcoin decouples favorably from broad equities because, companies are basically forced to pay higher wages. They're forced, they have all sorts of struggles with their supply chain shortages, things like that. While Bitcoin doesn't have margin pressure, doesn't have employees to play, things like that. And so I think it can decouple when you have very specific conditions that are hurting stocks that are not necessarily hurting Bitcoin. So basically, if liquidity is positive but margins are not great, that should be at least a decent shot of a positive decoupling. But we're not there at the moment. Right now, we're still seeing liquidity being pulled out, and so you see a lot of correlations go to one. And so another thing that fed the whole correlation issue is macro because it's been an unusually strong macro environment. So you had the COVID crash, then you had the biggest liquidity bazooka we've ever seen, and so the correlation of almost everything went up. And then as that liquidity bazooka is withdrawn, you see a lot of things roll over together. And so because we had a bigger than normal macro impulse, we have a bigger than normal amount of correlation. And I think over time that can separate. And things can separate in terms of size as well. And so for example, you can say, okay, Bitcoin and ARK are correlated, but if you look at a 5-year chart, Bitcoin has killed ARK in terms of total returns. And that's because over time, one is getting structural adoption and the other one less so. And so you can decouple in terms of timing, or you can just decouple in terms of magnitude, where say up days you do a little bit better, down days you do a little bit better, and over time you slowly separate from weaker assets.
No, that makes a lot of sense. It almost, and this isn't like a perfect analogy, but in my brain, it almost reminds me of that visual that Ray Dalio uses for like the long-term debt cycle, short-term debt cycle, where, as you just mentioned, like in the long term, the thing that's really driving Bitcoin in a 5-10 year time horizon is this adoption curve. And then on the shorter term time frame, you have some of these things that are driving the shorter term price action overlaid with that. No, I think that's super interesting. I honestly haven't thought of it that way before. So that's a really interesting framework. Kind of tying into that, what do you think about inflation? We had the CPI print earlier this week, came in, I believe, at 8.1%, a little higher than some people expected. Some people were expecting we would see for the first time, a substantially lower CPI print. How do you kind of think through inflation, especially heading into the end of the year? Because that's, I think, is especially like these forward-looking inflation indicators, I think, are kind of at the forefront of everyone's expectations for what's going to happen with Fed policy. So how do you kind of think through inflation moving forward towards the end of the year?
So monthly inflation's been high for over a year now, And when that happens, you start to kind of peak out in terms of year over year because you no longer have that. Basically, all the base effects wore off. And so, let's say you have 0.5% inflation every month, over a 12-month period, like when that starts to play out, you're going to be much higher year over year inflation than prior because your baseline is like 0.1 and 0.2% year over year inflation. And once you've had a full year of 0.5% month over month inflation, if you keep having that monthly inflation, your year over year inflation actually peaks out. It doesn't mean it goes down, it just means it kind of peaks out. And so you would need to see monthly inflation accelerate in order for year over year inflation to keep going up. Um, and so what we're seeing now is that the supply side is still very problematic. Energy companies are not really producing more energy. Uh, China lockdowns are rippling through the whole global supply chain. Semiconductors is still a problem. The eastern seaboard of the United States is nearly out of diesel, which is catastrophic. Um, fertilizer is still a problem. Basically, there are still structural supply side problems, and I think these are going to persist for a very long time. Um, Now, what we're seeing on the other hand is that demand is weakening because stimulus is being withdrawn, right? So when you're putting a lot of money and giving it to people, you could have that more inflationary impulse, and as you pull that away, then you're more likely to get economic contraction because people are forced to pay more for their food and energy, and they have to pay less. They have to tighten their belts everywhere else, right? So it's harder for other things to raise prices, and you start to get decreased economic activity and shortages. And so one thing that I think could make inflation come in not as high as people think is that it can manifest in shortages, right? So shortages are basically a type of inflation that doesn't show up in the numbers. If I want to buy something and let's say I'm willing, let's say, you know, they're out of paper towels and I want to buy some paper towels and I'm like, I will literally pay 50% above asking price if someone has paper towels to sell and I just can't find them, right? That would have been if I could find them, that would have been a high inflation print, but because I can't get them at all, it just shows up as a shortage. It just shows up as decreased volumes. So I tried to buy a car several months back and they didn't have any of the models I wanted and I just didn't buy a car. And if they would have said, "Hey, we have the car, it's 20% above asking," I would have been, "Yeah, okay. I'm gonna have it for a decade anyway, so it doesn't matter." Whereas because I couldn't even make that purchase, it doesn't show up as inflation, it just shows up as decreased economic activity. And so I think the combination of shortages and inflation are going to continue to various ways, but we're seeing that shift over time because it's no longer that high demand impulse. It's supply side scarcity and declining demand. And I think that's eventually going to do some sort of forcing function on either the Fed to reverse course, or we could start to see more targeted fiscal stimulus. You see in Europe, for example, some of them are doing energy subsidies. And I think we could see something like that in the United States. We start to see political pressure to address some of these situations, and so that could be that could increase liquidity in markets, but it's basically a very challenging decade going forward, I think, in terms of inflation.
Do you think that the stock market declining has had an effect on decreasing demand? I mean, in theory, this makes sense, right? Because you have like this reverse wealth effect. But then at the same time, it's like, well, stocks are mostly held by the top 1-5% in the country. So how do you kind of think through the effects as well as on asset prices declining and how that kind of translates to a potential like decrease in demand as well on the consumer side?
Yeah, there's really different variables for different wealth deciles. As you point out, people on the bottom don't own the stocks. People in the stocks have very different things that affect them than people on the bottom. And so if you're in like the bottom 90%, things like food and energy costs affect you greatly. It makes you have to spend less elsewhere to make your monthly budget work. If you're wealthy, if you're in the top, even just 10%, let's call it, that reverse wealth effect is really real, right? I mean, basically, their whole sentiment has changed around what they're going to spend, and they represent the majority of spending. The top 10% of people represent the majority of spending, especially on discretionary goods, and so a lot of that I think is going to be weaker. And so you have different variables for different markets. We also see that because mortgage rates have gone up a lot, the cost of buying a new home is a lot higher, right? So, if you have the same priced home and you have a 5.5% mortgage rate compared to 2.5% mortgage rate, your monthly payments are a lot higher. And that also means that fewer people want to move because if they move and sell their home, and they've already got a low mortgage rate locked in. When they buy a new home, they're going to be paying a higher mortgage rate, and so they either need to buy a smaller house to get the same monthly payment, or they're going to buy the same size house and get a bigger monthly payment. So you start to see kind of reduced mortgage activity and financing and movings when you see a rapid increase in rates. And the housing market is a pretty big driver of economic growth. And so I think across the board, whether it's wealth effect from stocks and bonds going down, whether it's energy and food prices going up, or whether it's housing costs going up. I think basically across the board for different reasons, you'll see weaker, discretionary spending, and we're already starting to see that show up in the data.